Welcome back, YouTube enthusiasts. In today's video, we're diving deep into the financials of one of the giants in the railroad industry, Union Pacific Corporation, ticker symbol UNP. Whether you're a seasoned investor or just starting out, you're gonna love the insights we have for you today. So, grab your popcorn, sit back, and let's get rolling. First up, let's talk about P ratios. Union Pacific's trailing 12 months P ratio is sitting at 22.15. What does that mean? Simply put, for every dollar of earnings, investors are willing to pay $22.15. Over the past 5 years, the average P ratio has been 21.92, so we're just a smidge above the historical average. Looking forward, the forward PE is expected to drop to 18.19. That's a good sign. It means the market expects earnings to grow, and the stock might be cheaper relative to future earnings. The PG ratio, which factors in earnings growth, is at 1.53. Generally, a PG ratio under 1 is considered good, but for a stable, established company like Union Pacific, 1.53 is pretty solid. It suggests that the company's price is fairly in line with its expected earnings growth. Insider ownership is a mere 0.31%. Not huge, but it means the folks running the show do have some skin in the game, albeit a small amount. It's always good to see executives having a stake in the company's success. Hold on to your hats, folks, because Union Pacific boasts a stunning return of equity of 45.45%. This means the company is incredibly efficient at generating profit from shareholders' equity. Return on assets stands at 9.59%, and return on invested capital is at 15.47%. These numbers highlight the company's efficiency in using its assets and capital to generate earnings. Union Pacific's current EPS is 10.48, and the forecast for the next 5 years shows an impressive growth rate of 14.5%. Over the past decade, EPS has seen a positive evolution with a compound annual growth rate of 6.92%. That's some consistent performance right there. Even more impressive is the free cash flow per share, which has had a fantastic evolution over the last decade, with a compound annual growth rate of 10.4%. This is crucial because free cash flow is what companies use to pay dividends, buy back shares, and fund growth. Speaking of dividends, Union Pacific has a dividend yield of 2.3% and has grown its dividend at a CAGR of 12.58% over the past 10 years. That's a reliable income stream for shareholders. But with a free cash flow payout ratio above 60%, it could indicate that this fantastic growth won't last any longer. Union Pacific's operating margin is a hefty 37.92%. And the profit margin is 26.52%. High margins like these indicate that the company is very good at turning revenue into actual profit. Over the past 8 years, both revenue and earnings have shown slight growth. However, this steady growth hasn't translated to explosive stock performance, resulting in a lower total return compared to the Vanguard S&P 500 ETF, VO, over the last 5 years. The company's debt-to-EBITDA ratio is 2.87, and its debt-to-free cash flow ratio is 6.80. These figures suggest that while Union Pacific carries some debt, it is manageable relative to its earnings, but relative to cash flow is more at risk. In the past 52 weeks, Union Pacific stock has delivered an average price return of 20.92%. With a market cap of $141.58 billion, Union Pacific is a heavyweight. Finally, analysts are predicting that the stock price will rise to $265.55 in the next 12 months, representing a potential upside of 14.44% from its current price of $232.05. However, my fair value estimate for Union Pacific is $226.30, which is closer to the current price. This suggests the stock might be fairly valued right now, according to my analysis. There you have it, folks. Union Pacific Corporation, a solid performer with a history of steady growth and efficient operations. Whether you're considering adding this titan to your portfolio or just learning about the company, I hope this breakdown has been both informative and entertaining. If you enjoyed this video, don't forget to smash that like button, subscribe, and ring the bell for more insights on your favorite stocks. Until next time, happy investing.